Let's talk about some of the things you're hearing on the internet. There is no shortage of short little TikTok clips or people with CPA in their name posting things on Twitter, X, whatever we're calling it now, telling you what's a good strategy and what isn't. First and foremost, you have to bear in mind that a lot of videos, especially short videos, including my own by the way, are going to omit key information. It's important to remember that these videos are educational in nature. There's no advice being given here. I'm not saying everyone should go out and do the things I'm talking about in the video. What we're going to talk about here has to do with the way you think about these strategies. Because the way we think about it, our mindset is ultimately going to determine our actions down the line. So here's the hit piece. You ready? Most of the things you think of as tax strategies aren't strategies at all. That's right, you heard me correctly. You hear of the S Corp, you hear of the C Corp, you hear of even Augusta. These things are technically not strategies. What these are tools. Every tool has mechanics. So we'll take the S Corp for example. The S Corp is the tool, and the mechanics of the S Corps are, for example, okay, you have to file an extra tax return. You have to take a salary through payroll. Okay, so those are the negatives. But the nice thing is, when you get your K-1 from this S corporation, you're not going to be subject to self-employment tax on the profits of the business the way you might in a partnership or in a sole proprietorship. So those are our mechanics. Now, the strategy is how we're going to use these mechanics. So if you're going to turn around and form an S Corp, and this is a real life example, by the way. I have a client who's a doctor. He had an S corporation when I met him, and his business made about $180,000 a year. Well, here's the problem here. Remember what I said about how he's a doctor? A reasonable salary for a doctor easily runs into that $180,000 range. So what's going to end up happening is he was taking all of his money through his W-2, which technically was correct of him to do because that's reasonable for a physician. The problem is it left him with no net profit in the company to actually benefit from the mechanics of the S corporation. Now, he didn't understand this because as brilliant as he is, he's a doctor. He's not a tax professional. He just operated under the assumption his CPA had him covered. Sound familiar? Unfortunately, when I looked at his case, I'm like, listen, not only is this not saving you any tax dollars, it's actively losing them. And the reason it's actively losing them is it gave him a reduction in his qualified business income deduction. That was a new deduction. It was added, well, it's not new anymore. It was added about 6 years ago today. But it was added back in 2018, and the W-2 wages he gets from his S corporation don't give him any QBID deduction. He only gets that if he has a profit, which he didn't because he was taking everything out as payroll. So with that in mind, the mechanics of the S Corp were working against him. It was working against him from a tax standpoint, and he was paying to run payroll, to file an extra tax return, all that stuff. So it was not only not saving him money, it was actively losing him money. Now, we can give a different real life example. Let's say we have Carol the realtor. Carol the realtor, she makes $200,000 net after expenses, pretty common for a lot of my own clients to make that or more. And then her salary was about $52,000 a year. Okay. Well, now the way this is going to work is she will pay self-employment tax equivalent, FICA equivalent, in the form of Medicare and Social Security tax on her salary. Okay, fine, but that's only $52,000. That extra $150 she's got left over, she gets that benefit of not paying FICA tax on that. Meanwhile, she's still going to get a pretty good amount of QBID because her business reported a decent amount of profit to base it on. The strategy itself is how you're going to utilize these mechanics, and whether or not the strategy works just comes down to the net outcome. Are you paying less taxes and less maintenance costs on things like tax returns than you would if you hadn't leveraged this strategy? And unfortunately, a lot of people have it where the answer is no. They just don't realize the answer is no because it's never been explained to them properly. And frankly, a lot of times I find these accountants, they don't necessarily know the answer themselves. Half the time they didn't even calculate their reasonable salary before they set up that S Corp. They just went and did it and assumed it would work. And you can't make assumptions in this business. You have to do very calculated maneuvers, much like flying an aircraft, to make sure that you stay on the proper path. So the next time you hear some strategy being sold on TikTok or an Instagram reel or whatever the case may be, don't get pulled away by what you hear people saying on the internet. What is going to work in their scenario is not necessarily going to work in yours. And a lot of times if something sounds too good, you know how the saying goes, if it sounds too good to be true, it usually is. At the end of the day, tax strategy has no free lunch. Every time you do something that's supposed to benefit you, there will be some kind of drawback. I talked about it earlier in the video. The key is making sure that what you sacrifice is smaller than what you get in return. Life is all about choosing what problems you want to deal with and what you want in return for dealing with those problems, not avoiding all problems altogether. You can't avoid all of your taxes, but you can reduce your taxes. You can get to where your taxes are fair, and that is the true objective of tax strategy. Hope you enjoyed this. Make sure you check out our dear friends Real Life Trading if you ever want to learn how to trade stocks, and I'll see you in the next video.